US Treasury yields are on the rise again, and global markets are paying close attention. But here's the twist. While the US faces bond market jitters, India might actually benefit. Let's break it down for you. Recently, the 10-year US Treasury yields climbed to 4.58% and the 30-year crossed 5%, levels that we haven't seen in months. This spike is being driven by weak demand at recent 20-year bond auction, ongoing inflation concerns, rising debt levels, and fears of more US bond supply flooding in the market. To add fuel to the fire, Moody's downgraded the US credit outlook, citing ballooning deficit and potential tax cuts. It's not just the US yields. The Japanese yields are also rising. The investors demand higher return of offset inflation and government debt risk. Meanwhile, in India, it's a different story. The 10-year bond yields is easing now around 6.2% thanks to strong demand. Why is that happening? The market sentiment is optimistic. Reserve Bank of India is expected to cut rates in the upcoming months and may deliver record dividend to the government, easing the fiscal pressures. The divergence between US and the Indian bond yields could open doors for foreign investment inflows into Indian bonds, which may strengthen the rupee and have a gentle push to the economic growth. So while the world's worrying about the yields, India might just find an opportunity in the chaos. For more such updates, follow us, and thank you so much for watching.